Hi, everyone. Scott Fischer here with Enza Financial, here to bring you June's monthly market update. June being quite an interesting month. Let me just pull up the screen here. And so we'll go ahead and get started. So what made June interesting was the Fed meeting, and what we had going into this, or what we thought was going to be the outcome, wasn't necessarily the case. Let's talk about equities first. So we're seeing still positive, very positive returns across the equity spectrum for this year. So if we look at the month, things were ups and downs, but for the year to date, we've got some quite positive returns. But let's just start with US and get down to business here. S&P 500 index up 2.33% for the month, 15.25% year to date. I'll tell you, if this is it for the year, we've already had a good year this year, but I don't think it's necessarily it, but we'll talk about that. The S&P 500 growth is seeing more positive returns versus what we saw in the first quarter, where we saw mostly negative for the growth and more positive for the value. We're seeing a little bit of flip-flop. This does have to do with the Fed's remarks earlier this month. So S&P 500 growth index up 5.68% for the month, 14.31% year to date. So it's gaining ground on value, where value was down 1.17% for the month, still up 16.30% for the year. We still think value is an opportunity for the remainder of the year. The 400 index, or the mid-cap index, down 1.02% for the month, but still up 17.59% year to date. And then small caps had a positive return of 0.33% for the month, and eked up to 23.56% year to date. So very strong returns across the U.S. As far as the equity indexes go. The FTSE All World, or international, we were down slightly, negative 0.66%, but still having a positive showing year to date of 9.43%. We still think there's opportunities to be had in international markets, and the same with emerging markets. The FTSE Emerging Index down slightly, negative 0.02%, but still up 8.12% year to date. So again, very strong returns so far year to date, the first half of the year, in U.S. and international equities. Fixed income is still a little bit of concern here. So far in the second quarter, we have seen some positive opportunities, or I should say, rebounding in the fixed income space. So bonds have seen more negative returns in the first quarter. They started showing up more positive returns in the second, but they really haven't made up the negative ground that they had in the first quarter. So the short term down 0.26% for the month and down 0.48% year to date. For negative, these would be exactly as we would expect. So you'd see more movement in longer duration than you would in the shorter duration. So you can see short duration year to date down negative 0.48%. Intermediate up slightly in June for the month, 0.37%, but down negative 2.69% year to date. And then the long term positive for the month, 3.57%, and negative 7.92% year to date. So this also ties into the Fed suggesting that inflation is still not a concern, and they also most likely not going to be raising interest rates anytime soon. So we're seeing a little bit of effect in both equities and the fixed income because of those comments. So going forward, what we're looking at, so not a lot has changed, but you can see we've pretty much pulled COVID off of our what we are watching list right now. But the biggest really is forward-looking earnings and the PE ratio. So as we've talked about in the past, PE ratio is still awfully high, and the PE ratio is a function of two things: price and earnings. So either prices are going to fall or earnings are going to continue to rise if we're going to see the PE ratio come back into where it should be. Right now, it's relatively high. The forecasted GDP looks great in the U.S. This year and next year, for that matter. So those are very positive things for the markets. The inflation and the Fed. So again, that's basically kind of what shaped the rest of June, was the Fed comments and the fact that they're not necessarily expecting that we're going to have long-term inflation. They did mention that we would see inflation, and they are not going to counter the effects of inflation on the short term. They actually want it to heat up higher than 2%, so that we get to an average of 2% instead of lowering it once it reaches 2%. So that most likely we'll see that we will actually have inflation rise above 2% over the short term. The Fed's not concerned about it, not going to be raising rates anytime soon. And then we still have the infrastructure bill, which is out, and most likely we'll see some type of passing of the infrastructure bill. And we also have the tax proposals that are out there. We've done a few things as far as providing information on the tax proposals that are out. We don't necessarily think they're going to pass in the current form, but we will be continuing to monitor that and let you know what we think could potentially happen. And we think this is probably most likely slated for later in this year before we actually see anything. So for the right now, if the year is shaping up, or at least the summer, exactly as I would expect it to. Summer doldrums bringing less volatility, or at least less trading activity, I should say, and kind of a slowing. So we're really seeing volatility, but going kind of nowhere fast. I would anticipate that potentially holds true through the rest of the summer, and then we could see more activity towards the fall and winter months as we get closer to that. So as of right now, things look good. The market looks good. Both equities and fixed income doing what we anticipated that was going to happen. So if you have questions, feel free to reach out, and look forward to our economic update, which will be coming out the middle of next month. Appreciate it, and hope everyone has a great day. And as far as the timing goes, a great